I said today that I'd talk about the RBA and the cash rate decision and where I think the future ones are going. There is an implication for the currency, which I will briefly touch on. And I also said I would talk about the market. And in talking about the market, I'll talk about our enhanced model of the ASX 200, which I've been trialling over the last couple of months, even though it's already been shown in the quarterly institutional presentation. The issue that Glenn Stevens has now, and that Phil Lowe will have when he takes over as Governor of the Reserve Bank of Australia in October, is core inflation. They've successfully targeted core inflation at around about 2.5%, since the early 1990s. Glenn Stevens has achieved an average core inflation rate of 2.47%, which is as near as you can do to a perfect record of hitting a target between 2 and 3%. The problem now is that core inflation is much lower than that. And as I noted in the piece yesterday, the average of the two published measures of core inflation, the weighted mean and the trimmed mean, are now 1.5%. And now think of this, as I'll try and put this as simply as possible. They're trying to achieve a target of 2.5%. And previously, to support that, they ran an interest rate 50 basis points below that of 2%. So if they've got actually achieved 1.5%, then they very logically should be running a cash rate of 1%. And running the models yesterday after the announcement, that's where you get to by February next year. So what I've said in the piece yesterday, that there will be another rate cut in November after the September quarterly CPI is published. But if numbers stay where they are and inflationary expectations stay where they are, and I'll enlarge on what I mean by that, we'll get a further rate cut after that November rate cut in February and knock it down to 1%. In the piece yesterday, I noted that in the model we have both the level of inflation, core inflation, which I've just spoken about, and inflationary expectations. Where do we get inflationary expectations and what are they? Inflationary expectations aren't just domestically a result of the domestic economy, they're an international effect, the international inflationary expectations. And Glenn Stevens referred to this. He said inflation was soft, as it obviously is in Europe, where it's around about zero. And as it obviously is in Japan, where it's around about zero. The only place where inflation is actually picking up is in the United States, where core inflation for the last 2 quarters, in terms of the personal consumption deflator, if you get the last 2 quarters and you annualize that, you've actually got core inflation there running at 1.9%, which is the Fed target, which is why the Fed will surprise everybody by putting up rates in the next few months. But I'll just say that so that everyone knows that I've said it and get back to what's happening in Australia. In Australia, we get our inflationary expectations from the bond market, and the Australian bond market is rising and falling on the back of the US bond market. And US bond yields are the lowest since 1789, which is something to be able to say. And that suggests that US inflationary expectations, apart from the actual number, are the lower even than when the United States was on the gold standard, which is extraordinary. So in that international environment of falling inflationary expectations, you really need to do more to compensate for that by lower interest rates. That's why I said on Friday, if I was running it, which I'm not, you would have cut rates 50 basis points yesterday with another 25 basis points in a quarter. Suffice to say that unless something happens dramatically different in the fundamentals, interest rates will continue to fall because inflation will continue to be weak. Now I'll talk about the market. I think in the short term we're going to have the normal seasonal correction. August and September are the seasonally weakest months. The reason that happens is because you're at the end of the US tax year. This is when US corporations tend to pay taxes to the government, and the government tends to make a surplus. And then from October, at the beginning of the US federal fiscal financial year, there's more spending than taxes come in, and so the market tends to reflate and go up. That's why the seasonality in the US stock market, and that's why the seasonality in the Australian stock market. But the longer view is that what's remarkable about the earnings season in the US, with 66% of companies reported, and what's remarkable about the forecasts for the future is just how good those earnings are. If earnings don't just improve between now and the first quarter of next year, they accelerate further through 2017. So if I ran my model, as I have during the week, and say what is fair value for the US market in say the first quarter of next year, I get a number of 2130 for the S&P 500. What is fair value for the US market at the end of 17? I get 2300, which is means even more upside. So what I think is that the US market has been correctly anticipating a significant improvement in US earnings in the second half of this year and throughout next year. And I think what we've got is we are facing a new upleg in the US bull market, and I think we will follow that. But I think we are going to have a short-term seasonal correction for the next couple of months. My model of the ASX 200, in the last quarterly institutional presentation, I showed two models. One, the traditional model based on earnings per share and bond yield, which I've shown for the last 20 years, and another one which is the which I call the enhanced model. The enhanced model explains about 93% of monthly variation. What's different, what it adds to that is US corporate credit spreads. There's been a lot of research done about this within the Fed system over the period since the financial crisis, and what this really represents is the amount of liquidity in the US wholesale market. So it's not saying anything about Australian earnings, but what it does tell us that as US earnings improve, then there's more cash available to buy back US corporate debt. That means we see that as the narrowing between US corporate debt yields and US sovereign yields. And all that means is there is more money available in the US wholesale system to flood in and buy Australian and other international stocks. And that puts upward pressure on the Australian equities market. This model is a lot whippier than the previous one. Fair value right now this week is 54.60. And we've moderately overshot that level, gee, we may come back to it in coming weeks. I said I would touch on exchange rate. I'll stick to my previously announced comment that I think the Aussie dollar will hit 70.5 cents by the end of the year, except I think with the interest rate outlook that I've been talking about, we will crush that objective.